Good afternoon, ladies and gentlemen. On behalf of the Securities and Exchange Commission of Thailand, I am pleased to welcome you to the seminar on revision to IESBA Code of Ethics, non-assurance services and fees. Today's objective is to provide you with the information on the revision to the non-assurance services and fees-related provision of the code, which were released in April 2021 and will become effective in this coming December. This afternoon, we are honored to have Kun Caroline Lee, the IESBA Deputy Chair and Partner KPMG as our speaker. To begin the seminar, may I invite Kun Ariwan Iamdilok-Wong, Director of the Financial Reporting Oversight Department of the SEC Thailand, to deliver the welcome speech. Please welcome Kun Ariwan.
Thank you. You can hear me okay?
Yes, I can hear
you.
Okay, yeah. Great. Thank you. Welcome everyone. Good afternoon, all the participants to our today's seminar. Today's seminar is on the revision to the IESBA Code of Ethics, non-assurance services and fees. Today we welcome our fellow auditors and also the member of the SEC Quality Assurance Review Panel. As we all know that in the audit professions, trust is key. And I believe that the independence is a very key element to maintain and build that trust. So I truly believe that with that in mind, the International Ethics Standards for Accountants, or IESBA, that's why there was a revision to this code of ethics to make sure that to address the issues on non-assurance services and fee-related provisions. And the purpose of, because it would be effective, this provision would be effective the end of this year. So the purpose of this today's session is to update all of you on what will be changed in the Code of Ethics. And today we are very honored to have Ms. Caroline Lee from who is the Deputy Chair of the IESBA and also the partner of KPMG. So thank you very much for taking the time out of your busy schedule to share your knowledge and experience, and also what's happening in the audit world and what will be changed at the end of this year. So thank you, and I hope it will be a useful session to all of you. So I'll give the floor to Ms. Caroline. Thank you.
Thanks, Kun everyone, and it's good to see you again, even though it's virtually.
Good to see you too. Thanks.
So now, before we proceed, allow me to make a few notes about how to send your questions during the seminar. We will have Q&A breaks after each session, so you can raise your question during those time, or you may leave your question in the chat box. Also, to facilitate with the seminar, we would prefer to have the question in English, but you can also raise your question in Thai also. We will translate them for Kun Caroline. So with no further delay, please join me in welcoming Kun Caroline from KPMG Singapore. Thank you.
Thanks, Kun Narinda. Sawadika and good afternoon, everyone. Thank you for having me here today to speak to you about recent independence revisions to the IESBA code. As Kun Ariwan mentioned, the focus is on non-assurance services and fees provisions. But before we get into that, I will take you through just an overview of the IESBA code, just to set the scene or set the background. And I will also end with an update on changes to the definition of public interest entities and listed entities, because that is closely linked to the non-assurance services and fees provisions. So just a bit about IESBA. It's an independent global standard setting board formed in 2005 that serves the public interest by setting ethical standards, including auditor independence standards. And it seeks to raise the bar for ethical conduct and practice for all professional accountants through the Code of Ethics. So on the board, we have 18 members, and there's a maximum limit of 9 practitioners. Our chair is an independent chair, Gabriela, and she used to be the chair of the Portuguese Securities Commission. We have official observers on our board from Japan as well as from our consultative advisory group. And we have representations across different geographies, including Africa, Asia, Europe, North America, South America, and Oceania. The work that IESBA does is facilitated by the International Federation of Accountants, or IFAC, and the oversight is by the Public Interest Oversight Board, who will ensure that our standard setting process is robust and follows our due process. As Kun Ariwan mentioned earlier, ethics and trust is actually important and central to our profession. And as a result, there's this strong public expectation towards the need for ethics. There's also increased regulatory scrutiny and intervention in different parts of the world. So now more than ever, professional accountants must focus on ethics and their responsibility to act in the public interest. Ethical thinking and ethical doing produce trust in the profession, especially in times of uncertainty and adversity. So the IESBA code is the bedrock of public trust in our profession. Now going on to telling you a bit about the code applies to all professional accountants, not only auditors, but also professional accountants in public practice that might provide tax services or other professional services. It also applies to professional accountants in business, including those in education, in non-profit or government sector. The code is principle-based, and this is fundamental to the global application of the code because it allows for the code to be applied in different jurisdictions in different circumstances. It stimulates ethical thinking about the appropriate conduct so that it's not driven by a checklist or checkbox when you have a rule-based approach. The code is versatile in dealing with a wide range of circumstances, so it's constantly fit for purpose, and it requires the exercise of professional judgment. Guidance is given to help professional accountants make that judgment and guiding them on what to do in certain specific situations. In 2018, the code was revised, and that revised and restructured code was based on 4 years of extensive research and consultation globally. So the code was completely rewritten with a new design, making it easier to navigate, use, and enforce. There are substantial revisions to the code, and there's now a new user guide section as well. So the revised and restructured code was released in April 2018 and became effective since June 15, 2019. And it was also renamed the International Code of Ethics for Professional Accountants, including International Independence Standards. This code is widely adopted and it's used as the basis for national standard setters. It's also used by IFAC member professional accountancy bodies in 130 jurisdictions and by the largest 32 international networks of accounting firms that carry out transnational audits. The 2018 edition provides a solid foundation of ethics and international independence standards, but timely adoption of recent revisions is important. We also have the code in electronic form, so it's part of the E-International Standards. In the 2018 code, in the Revise and Restructure,
Caroline, you mute your microphone. We can't hear you.
were you able to hear me previously?
Yes.
Okay, thank you. Sorry about that. So I was saying that the Revised and Restructured Code has significant improvements to the conceptual framework. There are safeguard provisions that have been enhanced to better align to threats. There are new guidance to exercise professional judgment and new material on professional skepticism in the context of an audit. In terms of non-compliance with laws and regulations, that has also been included in the Revised and Restructured Code. And the code has also strengthened the long association provisions. Provisions on inducements that were strengthened are also included in the code, along with strengthened provisions on preparing or presenting financial information. New provisions addressing pressures were also added in the Revised and Restructured Code. And there were clarifications around how Part 2 applies to professional accountants in public practice. Last but not least, there's alignment of Part 4B to the ISAE 3000 revised standard. So the International Standard on Assurance Engagement 3000. In more recent years, the code has been revised to incorporate the role and mindset expected of professional accountants. And the role and mindset provision is a very important provision that was added to the code. It deals with our responsibility to act in the public interest. In effective end of this year, 15th of December 2022, there'll be the non-assurance provisions, the fees provisions, and two other provisions on objectivity of the engagement quality reviewer and appropriate reviewer, as well as conforming amendments to ISQM 1 and 2, which is the standards on quality management. In 2024 December, there will be the definition of listed entities and public interest entities will come into effect. And the PI definition changes will expand the restrictions that are going to be introduced through the NAS and fees provision that take effect in December 2022. So just on the IESBA code, it has a building block architecture where part 1 is the foundation, and it sets out the responsibility to comply with the code and what it means to comply with the code. It also sets out the fundamental principles and the conceptual framework. Part 2 is for professional accountants in business. So if you're a professional accountant in business, you will apply part 1 and part 2. Part 1 being the overarching requirements, and then part 2 going into more specific requirements and guidance. If you're a professional accountant in public practice, you will apply part 1 and part 3. And if you're carrying out an audit engagement or a review engagement, then you'll also apply part 4A in addition to part 1 and part 3. If you're carrying out work on an assurance engagement, then you will apply part 1, part 3, and part 4B. The glossary will apply across the board and is part of the code as well. So in terms of part 1 on complying with the code, fundamental principles and conceptual framework, the fundamental principles remain unchanged. So there are 5 fundamental principles: professional competence and due care, integrity, objectivity, confidentiality, and professional behavior. So those 5 fundamental principles remain unchanged, but we have clarified and added application materials to help professional accountants understand what complying with these fundamental principles mean. Independence is not a fundamental principle, but we treat independence no different to the 5 fundamental principles, because the threats to independence and how we identify, address, and evaluate the threats to independence are the same as the threats to our compliance with the fundamental principles, and how we would identify, evaluate, and address threats to our compliance with the fundamental principles. So the conceptual framework guides us on how we go about identifying, evaluating, and addressing threats to our compliance with the fundamental principles and our compliance with independence requirements. So the threats, there are 5 threats: self-interest, self-review, advocacy, familiarity, and intimidation. When we are looking at non-assurance services, the focus is on self-review threat and advocacy threat. When we are looking at fees, the focus is on self-interest threat and possibly intimidation threat. So different threats could be more prevalent in certain aspects, but we have to consider all 5 threats and consider whether any of these 5 threats are present and would cause us to not comply with the fundamental principles or with independence. And if we identify the threat, then we need to consider, evaluate the threat, and we need to consider whether we can address the threat. So to apply the conceptual framework, we have to have an inquiring mind, we have to exercise professional judgment, and we have to use the reasonable and informed third-party test. So a reasonable and informed third party is doesn't have to be a public accountant. It doesn't have to be a real person. It's just someone who, with the available knowledge and information, what would they conclude? How would they view the circumstance, the situation? Would they conclude, like us, that the threat to our independence is at an acceptable level, or will they conclude that the threat is not at an acceptable level? In part 1, we have added additional requirements and application material relevant to the application of the conceptual framework. We've also added that in parts 2, 3, 4A, and 4B. Earlier on, I mentioned that the role and mindset expected of professional accountants is an important provision. And so this provision reinforces the profession's responsibility to act in the public interest, and it guides professional accountants to better demonstrate the role, the mindset, and the behavioral characteristics that's expected of us. It enhances the fundamental principles of integrity by involving the strength of character to act appropriately. So integrity includes now the requirement to have the strength of character to act appropriately. It also requires us to have an inquiring mind, and it clarifies that having an inquiring mind requires us to consider the source, the relevance, and the sufficiency of information, taking into account the nature, scope, and output of our professional activity, and being open to the need for further investigation or other action. So sometimes there might be additional information that comes to light, and we therefore need to take into account those further information. We might need to investigate further in order to come to a conclusion. So in applying the conceptual framework, the role and mindset provision requires us to have an inquiring mind. It also emphasizes the importance of being aware of the potential influence of bias when we exercise our professional judgment. And it sets out 8 different types of potential bias that we might encounter. So with increased awareness, the hope is that we would recognize whether or not we are influenced by any bias. The role and mindset provisions also require that we promote an ethics-based organizational culture. So it's not just the professional accountant that has to observe the fundamental principles and act in an ethical manner and uphold the code of ethics, but we should also encourage others in our organization to do the same by setting up, a process or mechanism that allows them to report unethical behavior in a safe, non-threatening manner, in a manner where they are not subject to retaliation and where investigations will be carried out appropriately. So I hope you see that the role and mindset provisions are very key in setting out our attitude and the mindset and behavior that we should have. In part 2, this is for professional accountants in business, and part 3 is for professional accountants in public practice. And some of the sections in part 2 are mirrored in part 3. So, for example, inducements, responding to NOCLA are also in part 3. So you'll see there's inducements, there's responding to NOCLA. So our code is applicable for all professional accountants, regardless of what kind of circumstance they are in, whether they are in business or whether they are in public practice. The code also clarifies that if you are a professional accountant in public practice, but you're carrying out some responsibilities for your firm, such that you are a professional accountant in business, so you're in the finance function of your firm, then when dealing with an ethical issue, you should apply part 2 of the code. So part 2 would also be applicable to professional accountants in public practice in certain situations. Another example could be where you are a treasurer or a director of a not-for-profit organization. Then, when you carry out your responsibilities, you also have to apply part 2. Part 4 is where we come to professional accountants in public practice, either conducting audits and review engagements for A, and assurance engagements other than audit and review engagements, which is part 4B. So in 4A, we have provisions that cover a whole host of situations that apply not only to the individual team members, but also to the firm and network firms, the firm and its network firms, as well as individuals. So in relation to fees, which we will cover today, in relation to compensation and evaluation policies for individuals, gifts and hospitality, actual or threatened litigation, financial interests, loans and guarantees, business relationships, personal and family relationships, recent service with an audit client, serving as a director or officer of an audit client, employment with an audit client, temporary personnel assignment, long association with an audit client, provision of non-assurance services to an audit client, and reports on special purpose financial statements. So we will deal with fees and we will deal with provision of non-assurance services to an audit client. 4B deals with independence in situations where the professional accountant in public practice carries out assurance engagements other than audit and review engagements. And so similarly, there are provisions on fees, provisions on non-assurance services to an assurance client. So at this point in time, just want to check whether are there any questions or comments?
There are no
If not-
questions at the chat box.
Thank you. I will continue on. So the next section that I come to then is on non-assurance services and fees. So these three projects, non-assurance services, fees, and public interest entity definition, are interconnected projects, and they enhance the international independence standards part of the code. It would have been ideal if we completed our PI definition at the same time as the NAS and fees projects. But the NAS and fees projects were very significant projects, such that we cannot actually overload various stakeholders with all three projects running at the same time. So what we agreed was, when we carry out the NAS and fees projects, we assume that it applies to public interest entity audit clients, however it is defined, and we'll leave it for the PI project to determine how to define public interest entities. One other thing I want to highlight is that NAS stands for non-assurance services. And the reason why it's non-assurance services and not non-audit services is that within the code, we have audit, review, and other assurance engagements. So the code is meant to deal with all situations where there's a need to be independent. And that need to be independent doesn't just apply in the case of audits. It also applies in the case of reviews and assurance engagements. And therefore, we are talking about engagements other than audits, reviews, and assurance engagements. So why change the IESBA code? The IESBA code provides a strong foundation, but we felt that there was work needed to strengthen the international independence standards, especially for public interest entity audit clients, because public expectation about auditor independence has changed. There were many jurisdictions that have changed their laws, regulations to be stricter, and there were also firms that adopted more stringent independence provisions. Making these changes would also be responsive to our regulatory stakeholders and the Public Interest Oversight Board's concerns about fees charged by audit firms and other public interest considerations. The projects are informed by research, public consultation, and global outreach. So we had various invitations to comment, as well as roundtables and public consultations. The revised NAS and fees provisions significantly strengthen guardrails around auditor independence, and there's comprehensive guidance to steer auditors' threat assessments and actions in relation to NAS and fees. So starting with the NAS provisions, non-assurance services, the key revisions to NAS is the introduction of new self-review threat prohibitions for PI audit clients. There's also new requirements for communication with those charged with governance for PI audit clients. And there's more clarification to assist the application of the conceptual framework to independence in identifying, evaluating, and addressing threats created by the provision of a non-assurance service to an audit client. So let's start first with the self-review threat and the application to all audit clients. So there's guidance to assist professional accountants in identifying threats and to determine whether a proposed non-assurance service might create a self-review threat. So firms must evaluate whether there is a risk that the result of the non-assurance service will form part of or affect the accounting records, the internal controls over financial reporting, or the financial statements on which the firm will express an opinion. And in the course of the audit of the financial statements on which the firm will express an opinion, the audit team will evaluate or rely on any judgment made or activities performed by the firm or network firm when providing the service. The service being the audit service. So these two prongs have to be present. The result of the non-assurance work will form part of or affect the accounting records, internal controls over financial reporting, or the financial statements on which we're expressing an opinion. And in the course of the audit of those financial statements, the audit team will evaluate or rely on any judgments made or activities performed by the firm or network firm when providing the non-assurance service. So in this case, whether that non-assurance service will be subject to audit procedures is irrelevant. So if you have a situation where you scope out certain work or you're not going to carry out audit procedures on a particular balance, and if that balance was based on judgments made or activities performed by your firm when they provided non-assurance services, then the risk exists that that non-assurance service might create a self-review threat. If that outcome of the non-assurance service is immaterial, it doesn't matter as well. So two things to remember, that it doesn't have to be subject to audit procedures, and it doesn't have to be material. What is important are the two bullet points, the two prongs that you see on this slide. Now we go on to a public interest entity audit client. So earlier on, I described the two-prong test for all audit clients. And in the case of a public interest audit client, public interest entity audit client, a non-assurance service that might create a self-review threat is prohibited because that threat cannot be eliminated. It cannot be reduced to an acceptable level by applying safeguards. So where there's a non-assurance service that might create a self-review threat, that non-assurance service cannot be provided to the PI audit client. Again, materiality is not relevant as I mentioned earlier. Another point to note is around communication with those charged with governance. So this is the second major change. And so here the focus is on transparency, and building on the extant code. There's now a new requirement to facilitate enhanced and transparent two-way communication between the professional accountant in public practice and those charged with governance. So unless it's otherwise addressed by a predetermined policy, the firm is required to inform those charged with governance for the PI audit client that the firm has determined that the provision of a non-assurance service is not prohibited and will not create a threat, or that threat is at an acceptable level. And they're also required to provide those charged with governance with information to enable them to make an informed assessment about the impact of that non-assurance service on the firm's independence. And thirdly, obtain concurrence from those charged with governance before they can provide that non-assurance service to the PI audit client, to any entity that controls that PI audit client, so the parent, or any entity that is controlled directly or indirectly by the PI audit client. So looking at the chart on the left, you can see the scope of entities that are caught. And this diagram here is just a simplified diagram. And above the parent might be another entity, another parent that controls the parent. So you have to go all the way up to the ultimate parent. So long as there's control, you have to go all the way up and downwards as well. So long as there's control, you have to control over the entities, you have to go downwards as well. So what kind of information should the firm communicate to those charged with governance? They should communicate the nature and the scope of the proposed service. They should communicate the fee and how the proposed fee and how that proposed fee is to be charged, how it's arrived at. So is it on a contingent basis? Is it based on time and material? Those kind of information. Information to be disclosed also include whether the firm has identified any threat to independence that might be created by the proposed non-assurance service, and the basis for the firm's assessment that the threats are at an acceptable level. So threats that have been identified and the evaluation of the threat, that the threat is at an acceptable level, and therefore the non-assurance service can be provided. And whether or not the combined effect of providing multiple non-assurance services creates threats or changes the level of previously identified threats. So if you're providing an engagement one time, there might not be, so let's say it's you're carrying out some review of controls. Carrying out that review one time might be permissible, but if you carry out that review on a recurring regular basis, then that review might change in form and might become part of the system of internal controls. And as a result, the combined effect of providing multiple non-assurance services could change the level of previously identified threats. So those are examples of information that should be communicated with those charged with governance. Where the communication is prohibited because of professional standards, laws, or regulations, or where the communication would result in disclosing sensitive or confidential information, then in those instances, the firm should provide information that it is able to without breaching the legal or professional obligations of confidentiality. And so the firm can inform those charged with governance that the provision of the non-assurance service will not create a threat to the firm's independence from the PI audit client, or that any identified threat is at an acceptable level, without describing the nature and the scope of the proposed non-assurance service. If those charged with governance do not agree with the conclusion, then that non-assurance service cannot be provided. So to give you an example, so going back to this slide, so here you've got a PI audit client, and let's say the parent is a listed entity, and the parent is looking to acquire or divest. So there's some merger and acquisition transaction that the parent is looking to undertake. And maybe that parent has then engaged the auditor of the PI audit client to carry out a financial due diligence, a tax due diligence on the target entity that it is looking to acquire. So that target entity is not part of the group currently. It's not audited by the firm or its network firm. And so that service is permissible because it doesn't affect the financial statements, the system of internal controls, right, of the PI audit client. And it won't be relied on, or for the results or services of the financial and tax due diligence will not be relied on for purposes of the audit of the PI. But that transaction could be price sensitive and therefore should not be in the public domain at this point in time. So we cannot tell this PI audit client's board of directors, those charged with governance at the PI audit client, about that transaction. But what we can tell them is that the service will not create a threat to the firm's independence, and if there is a threat, that threat is at an acceptable level. And if those charged with governance agree or concur with the conclusion, then you can go ahead and provide that non-assurance service. If the firm is not permitted to provide the required communication to those charged with governance, or those charged with governance disagree with the firm's conclusion that the non-assurance service will not create a threat to independence to the firm, then the firm must either decline the non-assurance service or end the audit engagement. So it cannot provide both services. So this requirement for concurrence from those charged with governance before accepting or before providing the non-assurance service, what can be done is that the firm might agree with those charged with governance a process that addresses when and with whom the firm is to communicate. So that process can be on an individual engagement basis, or under a general policy, or on an agreed basis. So it can also determine which entities that process will apply. And it might also include other PI audit clients within the structure. So upfront, agreeing a process, and within that, as part of that agreement, agreeing which entities will be covered by that process, identifying which services will be covered by that process without specific approval of those charged with governance. And upfront, they need to agree that the provision of that non-assurance service is not prohibited and would not create threats to independence that are above an acceptable level. The process also should establish how those charged with governance determine the authority for approving services, especially where there are multiple PIE audit clients in that structure. So if there are multiple PIE audit clients in the structure, then which set of those charged with governance would be reviewing the service? So for example, earlier on, I gave an example where this is a PI audit client, so a listed entity, and the parent itself is also a listed entity, a PI audit client. So you can set the procedure and agree that this maybe at this entity, the parent entity, those charged with governance will determine all the services for the whole group, for example. It also should establish the procedure where provision of information is prohibited or limited because of laws and regulations, professional standards, or disclosure might result in sensitive or confidential information being shared. And lastly, it should cover how issues that are not covered by the process might be resolved. So if there are services that are not within the scope, then what's the alternative procedure to be carried out to obtain concurrence from those charged with governance? So for the purposes of applying the provisions related to obtaining concurrence from those charged with governance, the provision of a NES to a parent entity of a PI audit client, paragraph R400.22, which sets out the related entities, and the definition of a related entity in the glossary are not relevant. So as a result, the requirements of R600.21 and R600.22 must be complied with even if the audited entity is immaterial to the parent or the PI audit client is not a listed entity. So it's not a listed entity here refers to situations where the definition of PI is expanded beyond that of listed entities. So what this is trying to say is that if I go back to this structure, if this was a listed entity, the definition of a related entity includes a parent entity, so controlling entity that controls the listed PI, and where the listed PI is material to that parent. But in this communication with those charged with governance, even if this listed PI is not material to the parent, so long as the parent controls this listed PI, you have to include the parent in the concurrence from those charged with governance for non-assurance services to be provided. Okay. So those are the general provisions and guidelines. Now, in section 601 to 610, we then have specific non-assurance services where we have provisions set out. So, for example, in terms of R600.9 to 0.5 to R600.9.6, 609.6 deals with recruiting services. And so we've strengthened the non-assurance service prohibitions for recruiting services for all audit clients. We've also strengthened the prohibition where the effectiveness of the service depends on a particular accounting treatment or presentation in the financial statements. So, for example, relating to tax advisory, tax planning services, corporate finance services. And certain tax services, the restrictions, the prohibitions have also been tightened. In terms of high audit clients, accounting and bookkeeping services, we've also tightened the provisions, valuation services as well, legal advice. And these are situations where they are prohibited to a high audit client when a self-review threat might be created. In terms of acting as expert witness and acting in an advocacy role, we've also strengthened the non-assurance service prohibitions. In terms of tax services are transactions related to marketing, planning, or opining in favor of a tax treatment that was initially recommended by the firm or network firm, and a significant purpose of the tax treatment or tax transaction is tax avoidance, then this non-assurance tax service is prohibited for all audit clients. Tax advisory and tax planning services where the effectiveness of advice is dependent on a particular accounting treatment or presentation in the financial statements, those services are also prohibited for all audit clients. In terms of tax calculation for the purpose of preparing accounting estimates, those are prohibited for high audit clients. Acting as an advocate before a tribunal or court in the resolution of a tax dispute, a tax matter, that is prohibited for high audit clients. So where the non-assurance service results in a self-review threat that might be created, then that service is prohibited for high audit clients if it relates to tax advisory and tax planning services, tax involving valuations, assistance in resolution of tax disputes. Okay. What is not prohibited is providing tax returns preparation services or tax compliance work. In limited circumstances, the provision of certain types of tax services are not prohibited, but only if specific conditions have been met. So some of those conditions include what we call a likely to prevail test. Going on to other assurance other than audits and reviews. So there's a need to consider the self-review threat in the case of non-assurance services that is provided to assurance clients other than audit or review engagement clients. So this is in part 4B of the code. And many of the specific non-assurance service provisions in section 600 for audit and review engagements are not extended to other assurance engagements. The primary focus of the non-assurance project was to respond to concerns about the firm's independence in the context of providing non-assurance services to audit clients. But we do have some application materials that help with the considerations of the self-review threat when providing other assurance engagements other than audits and review engagements. So there have been several resources made available in relation to NAS as well as fees and PI. There's the final pronouncement, the basis for conclusion, infographics, YouTube videos, webinars, PowerPoint materials. There's the NAS question and answer, and also the fees question and answer. Welcome back. I see there are some questions in the chat.
Yes, we have 2 new questions in the chat box. The first one is, what are the reasons behind why the IESBA has strongly believed that a NAS that might create a self-review threat must be prohibited for PI audit clients? Is it because the self-review threat either cannot be eliminated or reduced to an acceptable level by applying any safeguards?
That's right. So essentially, when it comes to a PI audit client, there's a heightened sense of independence required. So there's a higher expectation of independence, and that higher expectation of independence leads us to believe that even if there might be a self-review threat, that perception of independence is impacted. And as a result, we have to consider a stricter position because of that heightened expectation. So where the non-assurance service might create a self-review threat, then we should be prohibited from providing that non-assurance service. It doesn't lead to a situation where it actually does create. So that possibility, that risk, has to be taken into consideration. And because that risk is present, it's not possible to implement any safeguard or reduce in order to reduce that risk to an acceptable level.
Okay, thank you. For the next question, if an entity is planning to go for an IPO, the entity is not yet a PI yet. When providing IPO readiness service to an entity that is not a PI yet, would we still consider as if that entity is PI and apply the NAS provisions applicable to PI?
Okay, so at the current moment, there isn't a requirement to do so because the definition of a public interest entity audit client is restricted to listed entities. Unless, you know, in your jurisdiction in Thailand, you've expanded that definition to include entities that are planning or seeking to list. But when we get to the revised PI definition, that definition of PI expands, and therefore going forward, come December 2024, there will be, or when you adopt the PI definition, there'll be a need to think about independence even before the entity is listed. So an entity that is planning to list, we should start applying the independence rules as if it was a PI, even ahead of when it is listed.
Okay, and the next question. In case that the audit engagement team involves internal evaluation team to review the assumption in the financial model, for example, impairment model, the work will use only for audit engagement. You will still need to consider self-review threat for this additional work. If yes, is it still permissible?
Okay, so this is the auditor's expert. So the auditor's expert is meant to support the auditor in carrying out their work. And as a result, the work carried out by the auditor's expert is not considered to be a non-assurance service provided to the audit client. It's a service provided to support the audit team in carrying out its audit engagement. So there isn't a self-review threat in this situation. And so it is permissible for you to, to use your internal valuation team to support you as specialists, as external expert on your audit engagement. But if the client was to engage your valuation specialist to carry out a purchase price allocation valuation, for example, and then you have to audit that valuation, then that will not, that valuation service will not be permissible, because in carrying out your audit, you will be, evaluating the result of the work that was carried out by your valuation colleagues, and the valuation would be recorded in the accounting records and the financial statements on which you will be expressing your audit opinion. So in that situation, that non-assurance service is not permissible.
Okay, thank you. And the next question, for internal audit services, when the client implements our recommendations, will it be considered as self-review threat in case the new control is to be audited under the audit engagement?
Okay, so in terms of internal audit services, I think I replied earlier that if it is for a PI audit client, then the provision of internal audit services might create a self-review threat, and therefore it cannot be provided to a PI audit client. So in this case, if we assume that it is not a PI audit client, and therefore that service is permissible, when the client implements the recommendation coming up from the internal audit services, the client makes the decision. So we have to make sure that on the client side, they have someone who it's knowledgeable enough to understand the recommendations made and to implement it such that we are not assuming management responsibility. So there are certain conditions to be met to prevent us from assuming management responsibility. Those conditions should be set out in the engagement letter for the internal audit service. And so in that scenario, if the client was to implement the recommendation, then it's not a self-review threat because it's not, we've not undertaken or we've not assumed management responsibility.
All right, thank you. We don't have any more questions in the chat box. I believe we can continue to the next session.
Okay, thank you. So if we now go on to fee-related provisions, and at the end, I will run through some of the Q&As for non-assurance services and fees, and we will have time to take more questions as well. So now moving on to fee-related provisions, the key revisions address threats created by fees paid by the audit client. It addresses new provisions related to the level of audit fees. It has provisions around proportion of fees paid for services other than audit to audit fees. So the proportion of fees for services other than audit to audit fees. There's enhanced provisions on fee dependency, and it promotes transparency of fee-related information for PIE audit clients, transparency to those charged with governance and through public disclosure. So the first on threats created by fees paid by the audit client. So here, IESBA is not attempting to regulate the level of fees. That is the firm's business decision to make. IESBA's aim is to strengthen the guardrails around auditor independence. And so it raises awareness that there's an inherent self-interest threat when the audit client pays the auditor its fees. When fees are negotiated with and paid by the audit client, there's inherently a self-interest threat. So IESBA doesn't attempt to change the client-payer business model, but it wants to raise awareness that this risk, this threat is present. And it provides guidance to assist firms in determining whether threats created by fees proposed to the audit clients are at an acceptable level. So the level of fees is only one factor that could impact the evaluation of the level of threats created by fees paid by an audit client. The changes emphasize the importance of audit fee as a standalone fee. So there's prohibition for firms to allow the provision of services other than audit to influence the level of the audit fee. So for example, if you say that, oh, because I've carried out that internal audit service, I therefore would reduce my audit fee, or because I want to win that internal audit service engagement, I then reduce my audit fee. So that is prohibited. if you're able to reduce your audit fee because in providing that internal audit service, you get to understand the client's business and their system of internal controls. And as a result, there are cost savings achieved from providing that internal audit service to the non-PI audit client. Then it is possible to take into consideration that cost saving in determining your audit fee. So that exception is provided for. Another revision is around the proportion of fee. So IESBA did not introduce any threshold or any ratio as a cap or a fee limit to re-evaluate threats to auditor independence. The reason is that IESBA acknowledged that a cap or a threshold might not be appropriate in all circumstances. So, for example, earlier on we talked about a company that might be looking to list, and in that IPO process, there's work as reporting accountants, there's comfort letter work to facilitate the due diligence of bankers and advisors. And that work requires a lot of time, effort, and specialist skills. And also it's work carried out under extensive time pressure. So the fees would, there's also the risk profile for that might also be higher. So the fees for the comfort letter work or the reporting accountants work could be significantly higher than the, say, statutory audit fee. And so in that situation, your non-assurance service fee could be higher than the statutory audit fee. And given that this is one-off, it's for audit-related services, services that only the auditor, the firm can provide, then it doesn't make sense to have a cap or a threshold. So as a result, IESBA didn't introduce such threshold or ratio, but it acknowledges that a large proportion of fees for services other than audit to audit fees might create threats to independence. So it provides guidance to help firms determine what would constitute a large proportion in specific circumstances. So on the left, you see we have this balance. On one side, you've got audit fees for audit engagement, for review engagement. On the other side, you have fees provided to the client or related entities, fees charged by the firm, fees charged by network firms. All these have to be taken into consideration in addition to the type of service, whether the fee is commensurate with the type of service. Another provision is around fee dependency. So there were already existing provisions for related to fee dependency for PI audit clients. And what we did was IESBA strengthened those provisions. So no change to the extent threshold for PI audit clients, in that it's set at 15% for 2 consecutive years. But what has changed is that only a pre-issuance review by a professional accountant outside of the firm could be capable of reducing the threat to an acceptable level. So the safeguard, the only safeguard allowed is pre-issuance review, whereas in the extant code, it also allowed for post-issuance review. There's also a requirement for the firm to cease being the auditor if that fee dependency continues for 5 consecutive years. So IESBA's view is that fee dependency on a PI audit client cannot continue indefinitely. There are exceptional or special circumstances that we provide for in situations where it can go beyond the 5 consecutive years. Why 5 years? Why not 2 years? We thought long and hard about this, and we thought that sometimes if you have a new firm, a new entrant into the profession, it might take them time to build up their client base. And as a result, in the initial years, they might be dependent on, 1 or 2 or a few clients for their revenue. And as a result, that fee dependency might continue for more than 2 years. So 15% isn't a high threshold if you are just starting out and you've just got a few number of clients and you're building your client base. But after 5 years, we think that that should be enough time, and therefore there is a requirement for firms to cease being the auditor if the fee dependency continues for 5 consecutive years, except for special circumstances. And even under those special circumstances, there's a need for safeguards to be put in place. What about non-PI audit clients? So for non-PI audit clients, we introduce a threshold to be consistent with that for PI audit clients. But this threshold is 30%, and as opposed to 15%. And this is after 5 consecutive years. So after 5 consecutive years of hitting the 30% threshold, then there is a requirement for a pre or post issuance review by an external party, a professional accountant or professional accounting body, as actions to reduce the threat to an acceptable level. And also there's no exit clause and no enhanced transparency required in the case of non-PI audit clients. In the case of PI audit clients, there's a need to disclose fee dependency. So talking about fee disclosure and transparency, when it comes to fees, IESBA is of the view that it was more independence in appearance rather than independence of mind. So it was more a perception rather than actual non-compliance with the auditor's requirement to be independent. And so in order to address the perception, it was felt that transparency through disclosure would be helpful. So providing more information to stakeholders such that they can make informed judgment about the audit firm's independence. And in order to do that, firstly, there's a need to disclose information to those charged with governance. And then secondly, to the public. And this only applies for PI audit clients. So what needs to be disclosed? The fees paid by the audit client for audit and other services to the audit firm and its network firms, and fee dependency. So the fees paid include audit fees as well as fees for non-assurance services. A flexible approach would be useful in achieving this transparency. And so as a result, IESBA did not dictate what is to be disclosed, how it's to be disclosed, where it's to be disclosed. So disclosure of information that is essential from the perspective of the firm's information is what needs to be disclosed. IESBA acknowledges that the best way for this disclosure to be made would be if the audit client itself made that disclosure. So it's best presented by the audit client. So we start with our first choice is disclosure by the audit client within its financial statements, notes to financial statements, or other reports. But if the client doesn't want to make that disclosure, then the firm should first communicate with those charged with governance the benefit of this disclosure to stakeholders. And if the client still has not made that disclosure, then the firm has no choice but to do so. So disclosure by client, if there's any objection, discuss with those charged with governance the benefits of that disclosure. And if still the client doesn't agree to making that disclosure, then the firm has to make that disclosure. The flexible approach regarding how to achieve transparency is making sure that there's timely and accessible disclosure. So the disclosure has to be timely and in an accessible manner. And examples include the firm's website, the firm's transparency report, the audit quality report, any targeted communication to specific stakeholders, or the audit report. So these are various examples that IESBA has taken from the International Standards on Quality Management. And so it's left to the firm to discuss with those charged with governance how best and where to make that disclosure. So those are the key revisions around fees. Any questions before I go on to the PI project? Okay, we can circle back as we do the deep dive into the Q&A. Going on to the PI project. So the purpose of looking at the definition of listed entity and public interest entity was really to strengthen the independence requirements, as I mentioned earlier, and the heightened expectation as it relates to auditor independence in the case of audits of public interest entity audit clients have led IESBA to strengthen not just the non-assurance service provisions, but also the fees provision, and then to also relook at the definition of public interest entities. And how we went about determining what is a public interest entity is IESBA set certain baseline categories. And so this is the top-down approach. And these baseline categories are mandatory and cannot be removed. So these mandatory categories have to be included in the definition of PI, but they can be subjected to local body refinement. So no subtraction, but refinement is possible. So these categories would be publicly traded entities, banks, and insurers. Banks that take deposits from retail customers, and insurers that provide insurance cover to retail customers. So what is the level of refinement? In a jurisdiction, the national standard setter might take the view that in the case of banks that take deposits from retail customers, maybe it's only banks above a certain capitalization or a certain size. Or insurers, maybe it's covering insurers that have a certain premium size or revenue, premium revenue. So using size or revenue or value of deposits as the basis for determining those that are truly public interest, because you could have certain deposit taking entities that are small. So in Europe, there's the credit unions that are small, or it could be the savings and loan kind of small banks in the US. So there's the possibility of refining by specifying that it's only banks that take deposits from retail customers above a certain size or with a certain characteristic or criteria that meet a certain factor or criteria. Publicly traded entities. The national standard setter might also say that publicly traded entities exclude over-the-counter, for example. So there could be a refinement of what gets caught within the baseline PI category. So that's the top-down approach. In addition, there's the bottom-up approach. So the local standard setter, the national standard setter, should also add based on local circumstances. So for example, for us in Singapore, the Monetary Authority of Singapore has said that all those involved in the payment system have to be treated as public interest entities. And as a result, we don't just include banks and insurers, but we also include fund managers, capital market service providers, and various other parties. So from a bottom-up angle, the local body or national standard setter can add categories based on local circumstances. And to guide them, we have a framework of public interest factors and application material to help them see whether the category they are thinking of meets with the framework of a public interest entity. Third is for the firm itself to consider whether a particular entity should be treated as a public interest entity, taking into account more granular factors. For example, if those charged with governance are of the view that they want to subject their auditor to a higher independence restriction in the case of provision of non-assurance service, for example, or fee dependency, as we saw a minute ago, then in those circumstances, the firm would then treat that entity as a public interest entity audit client. There might be other reasons or factors that could trigger the firm concluding that it should treat an entity as a public interest entity. And so this should be paired with a transparency requirement. So as a result, you have in the middle PIEs, public interest entity, based on the top-down as well as bottom-up approach, and other entities that are treated as PIEs by the firm. And what happens to these entities? We will then apply the PIE audit client requirements to these entities. So in the IESBA code, there are sometimes sections that say the provisions are applicable to all audit clients, and sometimes there are sections that apply to PIE audit clients or non-PIE audit clients. So where it applies to PIE audit clients, then these categories of audit clients would come in. So in the code, we explain why the code has additional independence requirements for public interest entity audit clients or public interest entities. So the reason is that there's significant public interest in the financial condition of the entity. And this significant public interest in the financial condition leads to heightened stakeholder expectations on independence of the firm conducting the audit. And this heightened stakeholder expectation results in additional requirements to meet these expectations. What entities are public interest entities under the code? So in paragraph R400.17, using the top-down approach, it would be a publicly traded entity. It would be an entity, one of whose main functions is to take deposits from the public. It would be an entity, one of whose main functions is to provide insurance to the public, and an entity specified as such by law, regulation, or professional standard to meet the purpose set out in paragraph 400.10. So these three categories, publicly traded entities, deposit-taking institutions, insurers, these are the three mandatory categories. And we should take into account more explicit definition by local law of regulation or professional standard. So that's applying the bottom-up approach. And we should also add other entities specified by local law regulation or professional standards to meet the purposes in 400.10. And then we should take into account what else the local body is introducing. So here, we've got the high-level categories at the global level, and you then go through a local refinement, ending up with the PI definition at the local level. So once again, we cannot exclude entire mandatory categories, the 3 mandatory categories, but we can make it more, we can define it more explicitly. And we can also add additional categories by the local bodies. In the definition of audit client, we have a publicly traded entity and not a publicly traded entity. So in the case of a publicly traded entity, the client will always include its related entities. So the current extent code definition is that if your audit client is a listed entity, then when we refer to the listed audit client, we also refer or include its related entities. So the related entities would be the parent entity, where the audit client's contribution to the parent is material, the audit client itself, and downstream entities where the audit client has a controlling interest of those downstream entities. It also includes where the audit client has significant influence if it is material to the audit client. It also includes sister entities. So at the same, at the same row or same tier as the audit client, where both the audit client and the sister entity are material to the parent upstream. If the audit client is not a publicly traded entity, then the audit client definition only includes the audit client and those related entities which the client has direct or indirect control. So only the downstream controlled entities. So as I mentioned earlier, the firm is also required to determine any additional entity that should be treated as a public interest entity, a PI. So guidance is available to address the firm's responsibility to treat certain entities as PI under paragraph R 400.17 and 18. Firms are encouraged to determine if other entities should be treated as PIs. Firms should recognize that they play a role within the code's framework of public interest entity, and take into consideration the revisions of the exposure draft, revisions of the text as a result of the exposure draft on provisions. And lastly, adjust any non-exhaustive list of factors to assist the firm when making the determination. Transparency is important, just as it was for non-assurance services and for fees. So what is there to be transparent about? What is there to disclose in the case of public interest entities? So IESBA recognized the importance of transparency in meeting public expectations on firm independence. And as a result, the firm is required to publicly disclose if they have applied the independence requirements for PI to an audit client. That disclosure has to be in a manner deemed appropriate, and exceptions are made when the disclosure will result in the disclosure of confidential future plans of the entity. So earlier on, NES and fees, these provisions are effective December 15, 2022. ISEC has applied this to listed entities, to capital market entities. And in the case of PI, the effective date is 15 December 2026. So just like in the same way for NES and fees, we carried out, we held global webinars, we have videos, we have infographics. In the case of PI, we're still working on the Q&A, jurisdictional PI definition, and jurisdictional outreach and national standard setter panel discussions. So, if you want IESBA to come help you roll out, I know you have to translate your code, so we can help conduct the outreach activities, such as this seminar that we are having. So with that, I've come to the end of the presentation segment. And before we go into the deep dive and take more questions, just want to check whether is there any questions in the chat. Please stop presenting for a minute.
Okay, I see there are a few questions in the chat box.
Okay.
Are there any circumstances that accounting firms can provide valuation and lead M&A services to PI and any audit client respectively?
So valuation services. So if I go to slide 30. Valuation services are prohibited for PIE audit clients when because a self-review threat might be created.
Okay, I believe that is all for the questions.
So there's a question about whether is there fee dependency provision for non-PI audit client, and the answer is yes. So fee dependency provision for non-PI audit client is 30%. That's the threshold. And if it's 5 consecutive years, then there's a need for the safeguard to be put in place. And that safeguard could be pre or post issuance review. And there's no end to that, so that the 30% fee threshold or fee dependency can continue beyond the 5 years, but each year you have to apply the safeguard. Are there any circumstances that accounting firms can provide value? Oh, so this was the one that Kunawinda, you asked, right? Okay. Do we have any additional PIs as specified by local law? So I will leave you to answer later.
Yeah, it's no for now. I
Okay.
already answered in the chat box. Thank you.
Thanks, Kun Krisana. Is internal audit and external audit can both be performed for a PI audit client? So the answer is no. If you're carrying out the external audit, then for a PI audit client, internal audit services are prohibited because a self-review threat might be created, and that self-review threat would be at a level, would not be at an acceptable level. Any other questions? So the question is the next part of the question, but it can be performed for non-PI. It can, but you have to take into account, you still have to identify, evaluate, and address the self-review threat. And so if you evaluate that the self-review threat can be reduced to an acceptable level, then it is possible to provide that internal audit services. But there are factors and their application materials that will help. So let me see if I can refer you to. So internal audit services is in 605, section 605. And so R 605.3 says that paragraph R 400.13 precludes a firm or network firm from assuming a management responsibility. So when providing an internal audit service to an audit client, a firm shall be satisfied that A, the client designates an appropriate and competent resource who reports to those charged with governance to be responsible at all times for the internal audit activities and acknowledges responsibility for designing, implementing, monitoring, and maintaining internal controls. B, the client reviews, assesses, and approves the scope, risk, and frequency of the internal audit services. C, the client evaluates the adequacy of the internal audit services and the findings resulting from their performance. D, the client evaluates and determines which recommendation resulting from internal audit services to implement and manages the implementation process. And E, the client reports to those charged with governance the significant findings and recommendations resulting from the internal audit services. So apart from the self-review thread or link to the self-review thread is the risk of assuming management responsibility. So you have to make sure that you meet all these conditions or criteria. And so if that's the case, then if you have appropriate safeguards to address the self-review threat, then the provision of an internal audit service to an audit client that's not a PI and a safeguard to put in place would be to use professionals that are not audit team members to perform the internal audit service. So separation of team as a safeguard, in addition to making sure that you're not assuming management responsibility. But in the case of PI audit clients, then that's prohibited. Okay, regarding the requirements to cease being the auditor if fee dependency continues for 5 years, does it need to change audit firm? Yes. So in the case of PI audit clients, after 2 years, 2 consecutive years, you start with the pre-issuance review as a safeguard. And you still can continue to have that fee dependency of more than 15% until you hit the 5th year. And at the 5th year or at the end of the 5th year, you then have to change, you have to step down from being the auditor. If it is not a PI audit client, then there isn't a requirement to change audit firms. So if it's not a PI audit client, the threshold is 30% and not 15%. And you can continue with that 30% for 5 consecutive years, after which you have to implement the safeguard of pre or post issuance review. And you can continue with that audit appointment after the 5th year, so long as you continue to have the pre or post issuance review. The other thing to note is in the case of PI, the fee dependency has an exception. So the exception is so the exception is that the firm may continue to be the auditor after 5 consecutive years if there is a compelling reason to do so, having regard to the public interest, provided that A, the firm consults with a regulatory or professional body in its jurisdiction, and that professional body or regulatory body concurs that having the firm continue as the auditor would be in the public interest, and B, before the audit opinion on the 6th and any subsequent year's financial statement is issued, the firm engages a professional accountant who is not a member of the firm expressing the opinion on the financial statements to perform a pre-issuance review. So there are two conditions. One is you consult with a regulatory or professional body in your jurisdiction, and they concur that continuing to be the auditor is in the public interest. And the second, before you sign the report for the 6th or any other subsequent year, that you engage a professional accountant who's not a member of your firm to perform a pre-issuance review. So a factor which might give rise to a compelling reason is the lack of viable alternative firms to carry out the audit engagement, having regard to the nature and location of the client's business. So we were told that in certain places, in certain parts of Japan, it's quite remote, and there aren't many public accounting firms, and the industry could be quite specialized. The client could be in a specialized industry as well. And as a result, there's a limit to, or there's limited or no choice in terms of who can take on that audit appointment. And as a result, that fee dependency might continue beyond the 5 years. So it needs to have regulatory or professional body concurrence that continuance is in the public interest, and there needs to be a pre-issuance review performed by a professional accountant, not from the firm itself. In case the client will engage audit service and financial due diligence, commercial due diligence in different teams, could the firm accept the job by performing in different team or different entity? So firstly, the service cannot, you have to determine whether the service might create a self-review threat. So if your financial due diligence or commercial due diligence is on a target entity and not the entity that you are auditing, then there's no self-review threat in that situation. So you have to think of, is there an advocacy threat? Could there be, other threats that might be present, intimidation threat, or maybe self-interest because of the fee. So once you've determined all that, that there's no threat, or if there is a threat, by having different teams perform the two services, you can actually reduce the threat to an acceptable level. Then the firm can accept the job with different teams or different entities. Sorry, so Kun Krishana asked about slide 39. Can I clarify what are the exceptions in special circumstances that the firm may not have to cease in case the fee dependency continues for 5 consecutive years for Pi clients? So I have mentioned the 2 conditions that must be present. So basically there must be a compelling reason that it is in the public interest. And so the first condition is that there must be a regulatory or professional body that concurs that continuance is in the public interest. And secondly, there must be a pre-issuance review conducted by a professional accountant who is not from the firm that is issuing the audit report. Any other questions? Okay, if there's no questions, then let's go into the Q&A, because in the Q&A there's certain questions that are of interest and relevance. So let me call up the non-assurance service. Just sorry, give me a minute. Share. Okay. So this was given to you, and you can read all the questions that are here. It's very easy to understand, and I wanted to highlight a few questions. So question 9 is the first question that I want to cover, and this applies to advice and recommendation. So applying provisions relating to self-review threat to independence, including when providing advice and recommendation to an audit client. So the question is fairly long. So the question is paragraph R600.14 specifies how firms and network firms are to determine whether the provision of a non-assurance service might create a self-review threat to independence. So this is what we call the 2-prong test, because there's 2 parts, 2 prongs to it. In particular, it notes that before providing a non-assurance service to an audit client, a firm or network firm shall determine whether the provision of that non-assurance service might create a self-review threat by evaluating whether there's a risk that the result of the non-assurance service will form part of or affect the accounting records, the internal controls over financial reporting, or the financial statements on which the firm will express an opinion. And in the course of the audit of those financial statements on which the firm will express an opinion, the audit team will evaluate or rely on any judgments made or activities performed by the firm or network firm when providing the non-assurance services. So are firms to apply both elements of the above 2-prong test in determining whether a self-review threat might be created? How should a firm or a network firm interpret the terms form part of and affect in subparagraph 600.14a? So the response is that the 2-prong test provides additional direction to help firms and network firms determine whether a self-review threat to independence might arise from the provision of a NES to an audit client. Might create versus will create. So the phrase, whether the provision of that service might create a self-review threat, is the introductory wording and is intended to convey a clear threshold. The words, whether there is a risk that, explains what the threshold means and how it should be applied. In determining whether the proposed non-assurance service might create a self-review threat to independence, the firm or network firm will need to consider whether there's any possibility that the circumstances set out in each subparagraph will arise. IESBA settled on the threshold of might create instead of will create to reduce the possibility that a firm or network firm might breach the self-review threat prohibition because the firm incorrectly concluded that the proposed non-assurance service will not create a self-review threat, when in fact its assessment should have led it to conclude that there would be a self-review threat, even if such risk is remote. Okay. Proper application. So this gives the the explanation of why we use might create instead of will create. Proper application of the two-pronged test. So considering whether a proposed NES might create a self-review threat involves an assessment of whether there's a risk that the proposed NES will give rise to circumstances in subparagraph 14A and B. In the case of audit clients that are PIEs, if there's a risk that the circumstance in each subparagraph will arise, then paragraph R600.16 applies and the prohibition of the proposed NES is prohibited. So this says that if there's a risk that each subparagraph will arise, then the provision of the proposed NES is prohibited. Further, under the Code's drafting convention, the use of a lettered list, so A and B, means that the considerations in subparagraphs A and B apply and need to be satisfied together. So both have to be satisfied. Okay, so this response is important. What's also important is to note that a firm or network firm may provide advice and recommendations to an audit client that is a PIE if the advice and recommendation does not involve assuming a management responsibility and does not give rise to the risk of a self-review threat. However, the firm or network firm is still required to apply the conceptual framework to identify, evaluate, and address threats other than those related to self-review. So continuing on the answer, the meaning of form part of and affect. So the words form part of and affect are self-explanatory. The dictionary definition of the word affect is to have an effect on or to make a difference to, which was the IESBA intention in using that term. So when a firm proposes to provide a non-assurance service to an audit client, the firm considers the potential for interaction between the work involved in undertaking the proposed non-assurance service, which may include advice and recommendations, and the information that it can foresee considering in the course of the audit insofar as the accounting records, internal controls over financial reporting, and the financial statements are concerned. And when doing so, the firm is expected to apply the conceptual framework and the provisions in 600 to determine whether in its professional judgment, there's a risk that the results of the proposed NAS will form part of or affect the accounting records, the internal controls over financial reporting, or the financial statements on which the firm will express an opinion. So it's important that the relevant teams exercise appropriate professional judgment in determining whether there's a risk that the result of a NAS will form part of or affect the accounting records, the internal controls over financial reporting, or the financial statements. And in the course of the audit, there's a risk that the audit team will evaluate or rely on any judgments made or activities performed by the firm or network firm when providing the non-assurance service. Okay. So it's a very long answer, but if you go back and look at this and read it, it gives you a very clear explanation of what it means when we say might create a self-review threat, and when we look at the two prongs. The next question is question 11. So question 11. R600.17 provides that as an exception to the self-review threat prohibition, a firm or a network firm may provide advice and recommendations to a PI audit client in relation to information or matters arising in the course of the audit, provided that the firm does not assume a management responsibility and applies the conceptual framework to identify, evaluate, and address threats other than self-review threats to independence that might be created by the provision of that advice. Does the code provide examples of advice and recommendations that might be provided in relation to information or matters arising in the course of an audit? So yes, IESBA determined that the following examples of activities which are typically considered to be a normal part of the audit process should be permissible, provided the conditions specified in R600.17 are met. So R600.17 says don't assume management responsibility and then apply the conceptual framework. So the examples are advising on accounting and financial reporting standards or policies and financial statement disclosure requirements, advising on appropriate financial and accounting control and the method used in determining the stated amounts in the financial statement and related disclosures, proposing adjusting journal entries arising from audit findings, discussing findings on internal controls over financial reporting and processes and recommending improvements, discussing how to resolve accounting reconciliation problems, advising on compliance with group accounting policies. So all these are permissible. They are typically considered to be a normal part of the audit procedure or audit process and therefore should be permissible. The last non-assurance service example I want to cover is question 14. So question 14, are there some examples of NAS that might create a self-review threat and so could not be provided to a PI audit client? So the answer is the examples provided below are not exhaustive and are provided to assist in the application of the code's revised NAS provision. Each example is based on specific set of facts and circumstances. Different facts and circumstances might result in a different outcome when applying the code. So the first, advising a PI audit client on matters relating to accounting and bookkeeping arising outside the course of the audit. So advising on matters such as the implications of changing from one financial reporting framework to another might create a self-review threat if the advice includes the provision of estimates of the impact of the change in the accounting for specific line items in the financial statements. The judgments involved in making these estimates might subsequently be reviewed by the audit team for purposes of making judgments as part of the audit of the financial statements prepared under the new financial reporting framework. Valuation of an asset or liability for a PI audit client that is then incorporated by management in the entity's accounting records and financial statements. So earlier I talked about PPA, purchase price adjustment. So such a valuation will form part of the accounting records and financial statements and will present a risk that the audit team will evaluate or rely on the judgment and assumptions related to the valuation in the course of the audit. Therefore, irrespective of the materiality or significance of the valuation, the provision of that service to a PI audit client is prohibited. The same applies to the provision of a valuation service, the result of which might affect the accounting records of financial statements in ways not limited to accounting entries related to tax. For example, if the valuation relates to revaluation of assets. A litigation support service that involves estimating or might affect the estimation of damages or other amounts that will affect the financial statements on which the firm will express an opinion. And the third, corporate finance services that involve advising a PI audit client on investment or divestment decisions or options regarding capital structure. So advising a PI audit client on investment or divestment decision or options regarding capital structure is not permitted if the outcome of that advice might create a self-review threat. The advice is not permissible if there's a risk that the audit team will evaluate and rely on the judgments made as part of that advice. For example, whether the actions taken met the requirements of the legal or regulatory directive that led to the divestment or capital structuring. Advice and recommendations that involve analysis of the related merits of options presented typically relate to matters that are complex or unusual and more difficult to implement. So whether an audit client has designated an individual who possesses suitable skills, knowledge, and experience to evaluate the options and decide how to proceed will be relevant when assessing whether the firm will assume a management responsibility for the client. Okay. So this is question 14. So here it's about valuation, it's about corporate finance. So earlier on, one of your questions was related to financial due diligence and tax due diligence. So due diligence service itself on a target is not will not give rise to a self-review threat, because the client would take that information and negotiate on what the final valuation or purchase price would be. So it's the what gets captured in the accounting records is the final valuation, not information that came from the due diligence engagement. So those were 3 questions that I wanted to cover on NES. And so let's go on to fees. So for fees, if we go to question 5. So question 5 is paragraph 410.4A3 sets out various factors relevant in evaluating the level of threats created by fees paid by an audit client. How can each of these factors impact the evaluation of the level of the threats? So here we have a table in the next 2 pages to explain how various factors can impact the evaluation of the level of the threat. So I won't go through every single one, but just picking up a few. So the level of the fees and the extent to which they have regard to the resources required, taking into account the firm's commercial and market priorities. So it's not feasible for the code to prescribe the level of fees a firm should charge for services provided to an audit client. This will be a business decision, taking into account facts and circumstances of the specific engagement, including the requirement of technical and professional standards. For example, a firm might decide to charge a lower fee for a particular engagement in an effort to establish or grow share in a new market. If in setting that fee, the firm gives insufficient regard to the resources necessary for the performance of the engagement, this might increase the level of threat. Okay, so linkage between the fees for the audit and those for services other than audit, and the relative size of both elements. So a large proportion of fees for services other than audit to audit fees might adversely impact the level of the threats, including from a perception point of view. If a firm charges a lower audit fee because it is able to charge significantly more fees for other services to the same audit client, this would be prohibited under paragraph R410.6, subject to the exception in R410.7. Okay. So there are various examples here. The nature, this one, the relationship of the client to the related entities to which the services other than audit are provided. For example, when the related entity is a sister entity. So the further the related entity is from the client in the client's group structure, generally the less influence the client will have on the commissioning of services other than audit by the related entity, and hence the lower the level of the self-interest threat in relation to the audit work. Okay. Next question. Question 15, which question 15. So paragraph 410.14A4 indicates that one of the possible safeguards in the case of fee dependency on an audit client for a firm is to have an appropriate reviewer who is not a member of the firm review the audit work. Paragraph 410.14A7 indicates that one of the possible safeguards in the case of fee dependency on an audit client for a partner or an office of the firm is to have an appropriate reviewer who is not involved in the audit engagement review the audit work. Why are these possible safeguards not the same in these two cases? So in one case, it's an appropriate reviewer who is not a member of the firm, and the other, it's a partner or it's an appropriate reviewer who was not involved in the audit engagement. So in the case of fee dependency for a firm, IESBA is of the view that only a review performed by an appropriate reviewer who is not a member of such firm could be a safeguard, because any member of the firm is likely to have a self-interest in the firm's financial position. However, in the case of fee dependency for a partner or an office of the firm, the reviewer may be a member of the firm provided they were not involved in the same audit engagement, because the level of self-interest in a partner's or an officer's financial position might differ member to member. So the IESBA considers that the threats with respect to the firm are at a more systemic level, and therefore the possible safeguard is more demanding. Regardless of whether the fee dependency is at the firm, office, or partner level, threats to objectivity of the individual to be appointed as an appropriate reviewer would need to be considered. And last but not least, let's look at question 31. So question 31 is a fairly long question. So it starts with a firm is the auditor of a PI audit client P. The firm is also the auditor of a PI audit client A, which is an intermediary group wholly owned by P. PI audit client B, which is 75% owned by P, and non-PI audit client C, which is 51% owned by P. Both A and B are consolidated into the group financial statements. Maybe I should reduce it. Prepared by P. However, C is not consolidated into P group financial statements. In addition, the firm audits the financial statements of P and A as single entities, standalone entities, single entities. Some network firms are involved in the audit of A's group financial statements. If the client does not disclose the relevant fee-related information, what should the firm publicly disclose with respect to P, A, B, and C, assuming there's no confidentiality law restricting such disclosure? Okay, so this is the structure, right? There are three PIs in the group. These two, as well as this group that's consolidated, but this is 51%, so it's controlled but it's not consolidated. So A, the firm's responsibility for disclosure as the auditor of entity P. So the firm is required to disclose fees paid or payable to the firm and network firms for the audit of the group financial statements. And so 410.31b requires the disclosure of fees other than those disclosed under 31A charged to the client for the provision of services by the firm or network firm during the period covered by the financial statements. For this purpose, such fees shall only include fees charged to the client and its related entities over which the client has direct or indirect control that are consolidated in the financial statements. Paragraph C requires the disclosure of fees charged to related entities that are not included in the consolidation if the firm knows or has reason to believe that such fees are relevant to the evaluation of the firm's independence. So accordingly, the firm will publicly disclose fees paid or payable to the firm and network firm for the audit of the group financial statements of P. Fees other than those disclosed under 31A for services provided to P, A, and B by the firm or network firm. Fees other than those disclosed under paragraph A and B for services provided to entity C by the firm or network firm if the firm knows or has reason to believe that such fees are relevant to the evaluation of the firm's independence. Disclosure requirements in 31 are also applicable to the firm as the auditor of the financial statements of P as a standalone entity. However, to avoid duplicating the disclosure efforts, 32A provides an exception for the fee not to disclose separately the fee relating to the audit of the financial statements of P as a single entity, since it's already included in the disclosure relating to the group financial statements. Okay, so that is P, and then we go on to A. So given that the firm also audits A, 31 also applies with respect to that audit as A is a PI. However, as A is a wholly owned subsidiary, 32B provides an exception to avoid duplicating the disclosure of the same information in the group financial statements of P and A. And then you go on to B. So if you recall, sorry, B is this pie that is 75% owned by P and consolidated. So in the case of B, given that the firm also audits B, 31 applies with respect to the audit of entity B as it is a pie. However, entity B is not wholly owned at 75%, so the exception under 32B does not apply. Given that there are other shareholders in entity B, it would not be appropriate to withhold the fee-related information from those other shareholders. Accordingly, the firm will need to comply with 31 fully. So you can see that it can be quite complicated, and then there's C as well. So it can be quite complicated, and so I encourage you to read the Q&A. It's really useful and helpful. So with that, I would like to thank you all for your attention and for your participation, for the questions that you've raised. Thank you very much. And I hope that you found this session to be meaningful, to be useful. if you do have any further questions, please feel free to reach out to myself or the IESBA staff. Thank you.
Hi,
Nawinda, back to you.
Can I say a
Okay.
few words before we close? Hi, Caroline. Very nice
Hi,
to meet you.
Kuntawachai.
Very nice to
Kunta.
meet you here, even though it's a virtual meeting. Thank you so much for sorry that I couldn't welcome you myself at the beginning of this session since I was in another meeting. So I joined this
problem.
session a few minutes late. I do hope to see you in person soon somewhere. Thank you so much for spending time from your super busy schedule sharing with us the revision of IESBA Code of Ethics. Your sharing and answering questions does provide better understanding and insight on the revision of the IESBA Code of Ethics. I think it is essential that accountants have to apply Code of Ethics consistently to enhance public trust and confidence. Without Code of Ethics, without public trust and confidence, our profession will not have any value. Once again, thank you very much, Caroline, and hope to see you soon.
ขอบคุณค่ะ Thank you.
Okay, thank you, ladies and gentlemen. On behalf of the SAC Thailand and all participants, I would like to express our thanks to Kun Caroline for taking time off your busy schedule to provide us with insightful presentations. And thank you all participants very much for your kind participation and attention. I hope you found today's seminar informative and useful. We hope to see you again in the next seminar. Thank you very much.
Thank you. Have a good day. Bye.